Today on Retire with Purpose, the best ways to increase your investment returns. Do Roth conversions make sense for you? And if you own mutual funds, you might be paying too much.
Are you prepared to retire with purpose? To retire knowing your savings is invested to meet unavoidable needs and expenses.
It's not how much we make during the good times, it's how much we keep during those really bad times.
Certified financial planner Casey Weade is president of Howard Bailey, an advisory firm that believes successful retirement begins with a detailed financial plan personalized to help achieve your life's purpose.
Whatever risk you faced, we've got a plan.
The Howard Bailey team is committed to practical financial planning so you can enjoy family and the future without uncertainty or stress. Stay tuned and learn how you too can retire with purpose.
Thanks for spending some time with us. I'm Lee Kelso here with Casey Weade, certified financial planner and the president of Howard Bailey Financial. We're beginning today with an article from Bloomberg taking a look at the costs of costs that are hurting your investment returns. Something a lot of people don't really pay much attention to.
Yeah, well, I think it gathers attention, but we often pay attention to the wrong things that ultimately affect our investment performance. And they gave us a ranking within this article of the things that affect that performance, and really a ranking from the ones that most impact that performance to the least. And I think sometimes we focus on the wrong ones. We don't realize the complexity of how one may impact another. And this gave us a great breakdown of each individual one. And I think there are a handful of these that we see day in and day out with the families that come in and work with our team that consistently have the biggest impact, or the mistakes that have been made over the years. We've had the opportunity to meet with thousands of individuals that have been investing for decades, and we've been able to learn a lot about what makes someone successful in the world of investing and one that might ultimately lead to failure. And so we pulled those out of here, and we're going to talk about what I see as the most impactful ones. Of course, if you go to our site, you can sign up for weekend reading, you can get the full article and see what some of these other items are as well.
Well, as Casey said, we're going to cover 4 out of the 8, and first and foremost, as I mentioned, costs and expenses.
Yeah, we started with costs and expenses, and I thought it was right after security selection, and security selection obviously very important, but I personally probably feel that cost is a little higher on the list. But of course, we pick one perfect investment, then we've probably performed pretty darn well, but that's kind of hard to do. So right. I think we should probably focus more on costs and expenses over security selection. And we recently had someone that had sent us an email, one of our fans, and asked a question about fees and expenses. She had said, I think you focus too much on fees and expenses. Shouldn't it really be about the performance of that individual security or mutual fund as a whole? And I think, sure, she has a valid point. We should, of course, focus on the performance over the fees, but that's not really what the data and the research shows us. The research shows us, Morningstar has put out a white paper on this, explaining why we should focus on costs and expenses, because they found that costs and expenses were the number one determinant of long-term performance. And if we look at most mutual fund managers, most investment managers, they are not going to outperform the benchmark that's been put in place for them. So if we can keep those fees and expenses low, ultimately we're going to have a better opportunity for that long-term growth. And we're going to cover what all these fees and expenses are here later in the show, so you can figure out where those fees and expenses are and where money might be falling through the cracks.
Yeah, another key point is valuation and the year of your birth. So that has to do with timing and when are you in the market cycles.
Yeah, and if I love this one, valuation, year of birth, because I come from a different generation than a lot of the people that we work with. And what it pointed out is the valuation of the market. So what is the value of the market? Are we buying in at a good time? Are securities inexpensive, or they cost too much for that matter? And when we are born can ultimately affect when we start investing and in what type of market we invest in. If we look at individuals that were born in 1948, as the article points out, they hit their peak investment years between the ages of 35 and 65. So that's their peak earning years. When they started investing, 35 to 65, the market tripled in value. Interest rates fell from 15% to 1%. So their bonds performed exceedingly well. Their equities performed exceedingly well. They got a little bit spoiled, and compared to what I've experienced over the last 20 years when I started started investing in the early 2000s, I retired, or I started investing into an expensive market, and I had a negative investment experience in those first few years of investing. And so if we look at valuation, I think first we have to understand what valuation means. That means, what are we paying and what is it earning? You look at this when you're buying an investment, when you're buying a piece of real estate, when you're buying a business, you take a look at what the real value of that is. Basically, how long is it going to take me to recoup my original investment? And today, if we look at PE10, that's price to earnings 10-year average, which has been shown to be the #1 predictor of future returns in the market, what we find is today we're hovering around a 30. That puts us still in the second most expensive market in history. And that means that we're paying $3 million essentially for a company that's making $100,000 a year in earnings. So it's going to take 30 years to make back that original investment if we don't see growth in the individual security. We would never do that in the business world. You would never pay that much for a business entity or a piece of real estate. You might buy something that's 5 to 10 multiple, but you wouldn't go all the way out to a 30 or 35 multiple. And that's what people are doing today. And I think it's just because we don't understand. And so one is, what's the performance long term over the period of time that you're going to be investing? But I think it also has to do with the experience you have at the front end of your investing career. When I first started investing, I see these losses and I go, boy, this stuff just doesn't work. Right? You get kind of frustrated, and then that can lead to actually pulling back and sitting on the sidelines, moving funds into cash and not participating in investing, which we know over the long term, if we consistently invest, that's going to be one of the best determinants of our success on getting to retirement and through retirement.
So humility and learning the lessons along the way that can be painful, as you just described, that's an important factor.
And this is tough, because we all have egos, right? But if you look at the best investors, look at Warren Buffett, look at John Bogle, I mean, these guys have learned. They've made mistakes, but they had the humility to say, okay, I made a mistake, now I'm going to do some research, I'm going to learn from that, and I'm not going to do that again the next time. And I think advisors, financial advisors, we probably are most susceptible to this. Sure, I see it with investors, but I often see it with financial advisors because we go, this is our job, right? This is our job. We're supposed to know what we're doing. And so we start blaming their performance or blaming these mistakes on external factors that we say are outside of our control. And that's just not necessarily the case. It might have been our fault. And if we can evaluate that, be humble, and look into the alternatives, do our research, stay on top of the latest financial planning trends, evolve the way that we plan, evolve the products and tools that we use in our practice, we can make sure that we don't make those same mistakes again.
So that ties into the next one as well, and that is discipline and behavior.
Yeah, discipline, behavior. I mean, this seems to be kind of maybe beaten a little bit too hard over the years, but it is very true. Those that are very consistent and don't, I think, ultimately panic during the bad times, this is probably at the core of this, are the ones that were successful. And I think this starts with first having a plan and knowing this is what we're doing moving forward. This is my game plan. If we get the worst case scenario, if inflation goes up, we've got a plan for that. If we have a long-term care issue, we've got a plan for that. If we see rising taxes, we've already addressed that. If we see a down market, we've got a place to go for income so we don't have to panic during those times. We've got a plan. And I think it also, when it comes to investing, it comes to understanding our investments and the risks that we're taking on, because we often sign these little forms that says conservative, moderate, aggressive, and we say, well, I'm a moderate investor. But what's that mean? Is that really defined? Because it's different for Lee, it's different for me, it's different for you. Everyone has a different idea of what conservative, moderate, and aggressive does. So we use a tool called Riskalyze that applies a number to that risk. So you might go through our quiz on our website. It's a free quiz at retirewithpurpose.com. Just click on stress test my portfolio. You might come out as a 50. Then we can compare your portfolio with that. You might say your portfolio is a 65. Well, maybe that means that you've got a 95% chance over the long term you're going to make 7% a year. Over the next 6 months, you have a 95% chance that your returns will lie somewhere between, say, -20 and +30, or -10 and +20, and that can give us an idea of what that downside risk is, what we can expect long term. If we have reasonable expectations, then we don't have to panic because we were prepared.
So that's kind of some of the thinking that you'll engage with when you meet with members of the Howard Bailey team, and the opportunity to do that is available for you right now. Hope you're one of the next 10 people to call the number on your screen and request a complimentary review of just what's going on in your financial life. Taking a look at some of the fees we just talked about. You might be able to reduce those fees or eliminate them entirely in some cases. We'll take a look at what kind of planning is there for a long-term income, one you can't outlive, and then taxes. They're on sale right now. We'll look forward and do some estimating and think about how can you take advantage of the current circumstance and minimize your tax impact. All things that you'll get as part of this complimentary review, and we hope that you'll be one of the next 10 people to call the number on your screen and set yourself on the path toward retiring with purpose. All right, when we come back, we're talking with you again, answering your questions, so stay with us.
At Howard Bailey Financial, every dollar has a purpose. We call it the purpose-based retirement. A certified financial planner will help you decide what you need your retirement money to do for you. We put together a written plan that puts your dollars exactly where you want them to be. And we put every dollar to work to maximize your retirement efficiency. For a higher level of insight and care, choose the purpose-based retirement from Howard Bailey Financial. Call us now to set a complimentary consultation.
People send questions to info@howardbailey.com through the week. We pull out a few of those folks and invite them to join us on the program, ask their questions to Casey, and Monica's done that, so go right ahead.
My advisor is a CFA. Is that better or worse than a CFP?
Well, Monica, that's a valid question. There's this litany of different designations that are out there, and largely a lot of these designations have really just been created to fabricate credibility. And it's important to ask ourselves if these designations really mean something. Do they have real value? Do they actually have depth to them? What were the requirements in order to get them? What were they put there for in the first place? What kind of education are they put there for to provide to the advisor and enhance their expertise in a certain area? Some of these things that are out there, you can pick up a designation, throw a couple letters after your name, look like an expert in a 2-day workshop that you took over the weekend without any exam, without any educational requirements beyond that, or without any prerequisites of experience. CFA and CFP, much like CPA, these are kind of the three pinnacle designations in the financial industry, and they really mean something. They mean somebody went through a tremendous amount of education, put in a tremendous amount of effort. They went through a board exam. They have prerequisites that require them to have a certain amount of experience, a certain level of education prior to actually getting the designation in the first place. And when we know CPA, that really applies more to the tax world. We think about CFA and CFP, that applies more to the financial world of investing and of financial planning. A CFA is a chartered financial analyst, and this is, again, a very difficult designation to get, but it is providing expertise in the world of investment management. That is the expertise of these individuals, is mainly accumulation planning. So on your way to retirement, really it's all about accumulation for the most part, keeping your fees low, having the right security selection, making sure that you have the right asset allocation, and these individuals know how to evaluate the economy and the markets, and that's typically their focus, is investment management. If we're now transitioning into retirement, now we need more planning. We need to have an income strategy. We need to have a tax strategy. We need to have a health care strategy moving forward. We need to have an inflation strategy, an estate plan. Now we want to work with someone that's not just an investment manager, but is also a financial planner. And a certified financial planner is just that, someone that's focusing more on financial planning over investment management. I think both of these individuals, along with your CPA, are going to be the ones that you need to be successful throughout retirement. And on our team, we're going to have CFPs, certified financial planner practitioners, to do the financial plan, be the quarterback, and then we're going to have CFAs, chartered financial analysts, that are going to manage the investment portfolios and bring that experience to the table. We're going to have the CPAs come in and review any tax strategies that have been evaluated and ultimately implement those things for the individuals that we work with.
Thanks for your question. We're going to get to Stephen and Marion and his question about Roth IRAs.
We want to begin doing Roth conversions, but I'm 75 and my wife is 65. Whose IRA do we convert?
Stephen, great question. This is the time, it seems like the heyday of Roth conversions right now because of the Tax Cuts and Jobs Act. We've seen tax brackets become much more favorable, and we can make a lot of sense out of doing Roth conversions, and probably taxes will go up at some point in the future. So you could say that taxes are on sale for a limited time only, and we have to start asking ourselves questions like this. Now, the reality, Stephen, is both of your IRAs, if you're going to be leaving those IRAs to one of the two spouses, they have the same lifetime. So that's what you want to think about when you're evaluating these IRAs. What is the lifetime of this IRA? Who is it ultimately going to? What is the purpose of these dollars? If you're ultimately going to leave it to your spouse, then it doesn't really matter which one we convert. The one that's 65 or 75 is ultimately the other spouse is going to inherit that IRA. You can see them as having the same longevity or the same estimated lifespan. However, if you decide, well, we're going to leave when one of us passes away, we're going to leave this IRA behind to our children or to a church or to charity, then you can say, well, the lifetime of this IRA or this portion is shorter, and so we might decide to convert that IRA over another. So you want to evaluate what the lifetime expectation is of that IRA, and ultimately whoever gets it, what kind of tax rate environment are they going to be in?
Let's get up to Sturgis, Michigan, and Shelley, her question about risk. We are 20 years out from retirement, and our advisor tells us we need to stay aggressive, but we're getting concerned about going through another 2008. Is it okay to be more conservative, and how do we know?
Well, Shelley, I think the question is, what is your required rate of return? And that ultimately leads us into something that David Bach talked about on one of our recent Retire with Purpose podcasts. He talked about return on life, or return on retirement in his words. And that is, we should be focusing on really enjoying our lives during retirement, not just earning the highest rate of return we possibly can. And that starts with putting together a plan that evaluates, well, what do we need in order to be successful? And many a times we find that it's not the 6 or 7% that we feel like we have to have, which means that we might be taking on more risks than we're comfortable with. We might find that your required rate of return is only 3% per year. And if it's only 3% per year, then you might be able to be more conservative. But on the other hand, we might find that your annual withdrawal rate, you need 7% a year. So you have $1 million, you need $70,000 a year in income. Well, you might have to take on a little bit more risk and be a little bit more aggressive, or prolong your retirement for that matter. So we like to focus on that required rate of return, and then we can start building a plan around that so you can ultimately have the most fulfilling life you possibly can. You have to always also ask yourself, what are the intentions of this financial advisor? Do they want me to stay aggressive? Do they want me to stay invested in the market? Because those are the only tools that they offer to me, and this is where they make their money. Or can they offer you more conservative strategies that fit where you're at today? Can they offer you a tool that gives you a 4% fixed rate for the next 5 years that takes care of all your income needs? Or do they need you to be in the market in order to create an income for themselves? So great question, and we really appreciate it.
If you're not really sure of what your retired rate of return is, here's an opportunity for you to find out, and that is to be one of the next 10 people to call the number on the screen and request a meeting with a member of the Howard Bailey team. We'll take a look at how much risk is really happening in your portfolio that you may not know about. Is it more than you really need to achieve your goals? Also taking a look at fees that you might be able to avoid that are dragging down the performance of your retirement portfolio. And then taxes. There is tax planning available today because of the tax cuts that just wasn't on the table a few years ago. Are you capturing all that benefit? Those are all some things we'll take a look at as you sit down with a member of the Howard Bailey team for a complimentary review of exactly how you're geared up for retirement and whether or not you're headed in the right direction. All right, let's get to our question of the day, and it has to do with costs in your portfolio. How much will a 1.1% fee cost in the way of total returns over 30 years? Casey has the correct answer when we come back.
At Howard Bailey Financial, every dollar has a purpose. We call it the purpose-based retirement. A certified financial planner will help you decide what you need your retirement money to do for you. We put together a written plan that puts your dollars exactly where you want them to be. And we put every dollar to work to maximize your retirement efficiency. For a higher level of insight and care, choose the purpose-based retirement from Howard Bailey Financial. Call us now to set a complimentary consultation.
Heading into the break, we asked our question of the day, and here it is again. What is the impact of a 1.1% fee? What's the cost in the way of total returns over 30 years?
Well, the answer, Lee, is C, 25%. Vanguard did a study, and they found that it'll cost 25% in total returns if you just had an additional 1.1% in annual fees and expenses. And this is why it's so important for us to understand what your fees and what your expenses are. And take this, for instance. Lee, when you go grocery shopping, I'm curious if you're kind of like me. When you go grocery shopping, do you kind of have an idea of what you're going to pay for different things and what the value is? Do you ever pay attention to that per unit price?
Absolutely.
And for me, and I know you shop at Aldi's
I do.
as well, which means you're someone that likes to get good value. And I'm the same way. I want to make sure I pay. When they came up that per unit price, I thought it was the best invention ever because I didn't have to worry about getting an empty bag of Tostitos. And the same thing's true. I mean, I think most importantly, you go to the grocery store, you know what you're paying when it comes to that bag of Tostitos. You go on vacation, you know what you're paying for your flight. You know what you're paying for your hotel stay. You know what you're paying for your rental car, for that matter. We know the price. And you also know, if you have streaming media services on your Roku, maybe Netflix or Hulu, you know what you're paying for those in most likelihood. If we look at a study that was actually done by TD Ameritrade not too long ago, they found that 95% of respondents knew what they were paying when it came to their streaming media services, $5.99, $7.99 a month for their Netflix or Hulu. And when it came to their investments, their mutual funds specifically, they knew what they were paying 27% of the time. So 27% of people know what they're paying for the mutual funds, 95% for streaming media services. Which one do you think costs more? $5.99, $7.99 a month, or $599 or $799 a month? And what we're going to walk you through is a case study to help illustrate the importance of this and also how you might be able to locate, understand, and find these fees for yourself. And I want to kick this off with a Forbes article written in 2016 that outlined, following research, where we can find those expenses. The one that you're most probably familiar with are the disclosed expenses. These are the things like your expense ratio. And on average, U.S. equity mutual funds have an expense ratio of 1.19% per year. What they found, though, is that it doesn't stop there. There are internal expenses that don't legally have to be disclosed on a forward-looking basis. That would be things like transaction cost, trading cost. Every time there's something bought and sold inside the mutual fund, it goes through a brokerage house and there's a commission charged. They found that those fees, those expenses, added 1.44% per year. The Wall Street Journal was cited saying the average transaction costs on average double the cost of your average U.S. equity-based mutual fund. And then they outline the tax cost. If you have mutual funds in an after-tax account, then every single year they're kicking out capital gains, dividends, and interest that are creating tax drag on your returns, if you will. And that tax drag will ultimately affect your net return. One of my favorite quotes came from Warren Buffett, and he said this, very important: never spend money on money you're not spending. But that's exactly what you're doing if you own mutual funds and they have a high turnover where they're trading on a consistent basis, they're creating taxes, and that ultimately adds up to 3.73% in total fees, expenses to you before you actually earn a dime in return. So let's start to understand where these are. We're going to use an example, and this example came from a case that we audited here earlier this summer, and this was a longtime client that came in and said, I just don't feel like this account that he had just become a trustee on, he wanted us to take a look at it because he said, I've got this account, it's been over here for a long time, it's not mine, I'm just looking over it for a family member, and it feels like it's just not doing what it's supposed to be. It's not performing. They were paying 1.25% in advisory costs, but he just didn't think that made sense. 1.25% didn't seem too bad. So we started breaking it down. We took this $230,000 account and we had to take into consideration it was an after-tax account, so there was going to be some of this tax drag created. So we took a look at the individual mutual funds. We added up all those different expenses. What we found is this portfolio of mutual funds was being charged 1.25% in advisory costs to manage this portfolio of mutual funds. That was about $2,900 a year. On top of that, that, they had internal costs of the mutual funds of about $4,200 a year. That brought the total cost to that $230,000 investment for that client to $7,093.82 a year. His biggest frustration wasn't just that number. It was what that number meant to him and ultimately to his loved one. That was actually more dollars than she needed out of that account every single year in the form of income. There were too many hands in the cookie jar. And here are a couple of the hands that were in the cookie jar. We can take a look at this American Century Emerging Markets Fund, and we see it has a 47% turnover. That means if we start the year with a certain number of holdings, by the end of the year, we're going to have half of those holdings be turned over. They're going to be replaced or traded on, and that causes trading cost. If you just examined the prospectus and looked at the expense ratio that you're probably familiar with, you would have seen an expense of 1.06% per year. Once other transaction costs, tax costs were added back in, you can see the total cost of that mutual fund was 1.9% a year. If we take a look at a bond fund at the very bottom, this Delaware bond fund, 168% turnover. And I've seen turnover ratios in the 300% and 400% range. And this brings this 0.57% fund to a total cost of actually 2.1% per year. So in the end, we found $4,200 in mutual fund costs, $2,900 in advisory fees, $7,000 a year in fees and expenses on a $230,000 account. So what's this mean over the long run? Well, let's take a portfolio of $1 million. Let's invest it in a mutual fund, let's say, or a managed portfolio or securities, and say we had a 3.73% annual fee and it grossed 8% a year in annual returns. Well, even with almost a 4% annual fee, that million would turn into $3.2 million over that 30-year period. If we reduce that cost by just 0.73%, so marginally, still 3% per year, that 3.2 now turns into $4 million. If we knock it down to 2%, which is still an excessively high fee or expense for this day and age, we've now turned that million into $5.5 million, almost double what we would have had if we would have paid those higher fees and expenses of 3.73% per year. Knowing and understanding your fees and expenses and keeping them as low as possible is vital. For this account, we were able to audit, share with them their fees and expenses, and cut those things down by more than 2/3 and put that money back into their pocket where it belonged.
That is shocking. 3.2 million versus 5.4. That's shocking.
It's a huge number.
Yeah, it is. So what's a red flag that I'm paying too much?
Well, I think the biggest red flag would be, well, do you have mutual funds in your account? One, most mutual funds can be replaced today with some type of index fund or ETF or institutional class share. And even going further than that, if we have mutual funds inside of an advisory managed account, especially if they're actively managed mutual funds, that means we're actively managing actively managed mutual funds. We've got too many different layers of expenses.
Yeah, or as you said, too many hands in the cookie jar.
Yes.
Yeah. So if you'd like to learn more about what's going on in your own portfolio, the opportunity before you is to be one of the next 10 people to call the number on the screen and request a complimentary consultation with a member of the Howard Bailey team. It's a chance to sit down and take a look what's happening in your portfolio with fees and expenses and how can those be minimized. Is there a long-term income strategy? What about a long-term care strategy? All important factors for a successful retirement, things you'll talk about with a member of the Howard Bailey team with this complimentary consultation if you'll pick up the phone and call the number on the screen. We appreciate you joining us today, and we will see you next week.